Welcome to the Deep Dive Library, your go-to podcast for real talks on entrepreneurship, finance, and personal growth. No fluff, just bold insights to help you grow, build, and lead. Let's dive into understanding every business numbers.
Yeah.
Today, we're tackling a topic that can sometimes feel a bit, well, intimidating. Business financials, performance metrics.
Right, but it doesn't have to be. Think of it more like learning the language your business uses to communicate its health.
Like reading the vital signs.
Exactly like that. And our goal today is pretty straightforward. Help you understand those signs. We're talking about the key financial metrics you really ought to track, how to actually calculate them, what they mean for your business.
And crucially, how knowing this stuff helps you make, well, smarter decisions.
That's the core of it, better decisions.
And we're aiming to answer some specific things listeners have asked about, like what are the essential metrics? There's so many. Where do you even start?
Yeah, cutting through the noise is key.
And how do I figure out profit margin? Or maybe I should say profit margins, plural. Why are they so important?
Good point. There are different types, and they tell different stories.
Then there's CAC, its customer acquisition cost. What goes into that number, really? And importantly, how can I possibly lower it?
SAGAS. Always a big one. We'll definitely get into that.
And marketing spend, how do I know if it's actually working? You know, the ROI, the return on investment.
Measuring marketing ROI is crucial, yeah. We need to cover how to think about that.
Also, does what you focus on change much if you're a brand new startup versus, say, a more established company?
It definitely can shift, yes. The priorities evolve.
And finally, how often do I need to be looking at all these numbers? Is it daily? Weekly? Monthly? We'll talk about finding the right rhythm for review.
Okay, so we've pulled together insights from various experts and resources on financial performance, customer acquisition, ROI, startup metrics, trying to synthesize it all.
Ready to dive in.
Let's do it. So, starting with the basics. Financial KPIs, key performance indicators. What are they, in simple terms? They're just specific, measurable values that show how effectively a company is achieving its key business objectives, financially speaking. Think of them as gauges on your car's dashboard.
Right, telling you speed, fuel, engine temp, different things.
Exactly. And financial KPIs fall into categories too. You've got ones focused on profitability. Are we actually making money?
Okay.
Liquidity. Can we pay our short-term bills? Solvency. What about long-term debts?
Got it.
Efficiency. How well are we using what we have, our assets and resources? And sometimes valuation metrics, what's the business actually worth?
And the numbers for these KPIs, they mostly come from the main financial statements.
Primarily, yes. You're looking at the balance sheet. That's your assets, liabilities, equity at one specific moment, like a snapshot.
Okay.
The income statement that shows revenues, expenses, and profit over a period of time, like a video.
Right, over a month or a quarter.
And the cash flow statement, which tracks how actual cash moved in and out from operations, investing activities, and financing activities during that period.
And sometimes an annual report wraps it all up with more narrative. So these docs are ground zero for the data.
Absolutely. They hold the raw numbers you need for most calculations.
All right, let's tackle profitability first. Seems like the most fundamental question, right? Is the business making money?
It really is the heartbeat. Profitability ratios tell you how good the business is at turning its revenue into actual profit. And there are three main ones we should probably unpack.
Okay.
First up, gross profit margin.
This is the profit after you subtract only the direct costs of making your product or delivering your service. The cost of goods sold, or CAC.
Precisely. It doesn't yet account for things like rent, marketing salaries, R&D, just the cost directly tied to what you sold.
And the calculation is?
You take your revenue, subtract the cost of sales, then divide that result by the revenue. Multiply by 100 to get a percentage.
Okay, so revenue, CAC, yes, revenue. What does this tell me that the others don't?
It shows the basic profitability of your core offering before any overhead. It's super useful for comparing different product lines, maybe, or seeing how your fundamental efficiency stacks up against competitors in the same industry.
So if my gross profit margin is healthy, but I'm still not making money overall.
Exactly. It strongly suggests the issue lies in your operating expenses. Your overhead is too high, maybe.
Got it. So gross profit margin is layer one. What's next?
Operating profit margin. This one goes a step further. It takes your gross profit and then subtracts your operating expenses.
Which are things like?
Rent, utilities, salaries for admin staff, marketing spend, R&D costs. Basically, the day-to-day costs of running the business itself beyond just making the product.
So the formula here is gross profit operating costs, total sales.
That's it. This margin gives you a much clearer view of how efficiently your core business operations are running and how well management is controlling those more discretionary costs.
Discretionary because management has more direct influence over them than, say, the raw material costs and COGS.
Generally, yes. But context is still key here. A startup that's scaling fast might choose to have a lower operating margin because they're pouring money into sales and marketing. That's an investment in growth.
Whereas a mature company might be expected to show a higher operating margin.
Typically, yes. They're expected to be more optimized, more efficient in their core operations.
Okay, that makes sense. And the final one, the one everyone usually just calls profit margin.
That would be the net profit margin. This is the ultimate bottom line. It represents the percentage of revenue left after everything has been deducted.
Everything means.
COGS, all operating expenses, plus interest payments on debt, taxes, and any other non-operating income or expenses. Maybe unusual one-off items.
So net profit divided by total sales. This shows the overall financial health, right?
It does. It reflects how effective the company is, top to bottom, at generating profit from sales and controlling all its costs. But, as Karen Berman and Joe Knight point out, be a little cautious.
What is that?
Because net profit margin can be influenced by things that aren't part of your core ongoing business, like selling off a big asset or a major restructuring charge, these one-time events can skew the number up or down in a particular period.
So relying only on net profit margin could be misleading sometimes?
It could. That's why looking at all three gross, operating, and net together and tracking them over time gives you the richest picture. You see the trends, you see where the pressure points are.
Okay, tracking all three margins over time. Got it. They all come from the income statement data.
Mostly, yes.
All right, moving on from just profitability.
Right.
What about efficiency? Using your resources wisely.
Super important. That's where efficiency ratios come in. They measure how effectively you're using your assets and managing your operations to generate sales. A lot of the data for these comes from the balance sheet.
Like inventory turnover. I've heard that one.
Yep. Inventory turnover tells you how many times you sell and replace your entire stock of inventory during a given period, usually a year.
How do you calculate it?
It's your cost of sales divided by your average inventory value for the period. A high number generally means you're selling quickly. A low number might mean you're holding too much stock, which ties up cash.
Okay. What about total asset turnover?
Similar idea, but broader. It's your total revenue divided by your average total assets. It measures how efficiently you're using all your assets, buildings, equipment, cash, inventory, everything to generate sales.
Higher is generally better.
Generally, yes. It means you're getting more sales bang for your asset puck.
Now, what about cash? The speed of cash moving through the business feels critical for survival.
Absolutely critical. Managing the cash flow cycle is vital. There are a few key metrics here. One is accounts receivable days, often called days sales outstanding, or DSO.
That sounds like how long it takes customers to pay you.
Exactly. It's the average number of days it takes to collect payment after you've made a sale and sent an invoice. The formula is roughly your accounts receivable balance divided by your total revenue over a period, then multiplied by the number of days in that period, like 365 for a year.
So a lower DSO means you get paid faster.
Right, which is usually better for your cash flow. Then you look at the flip side. Accounts payable days. How long do you take to pay your suppliers?
Is the goal just to delay paying bills as long as possible?
Well, within reason. You want to manage it strategically. Ideally, collect cash quickly, low DSO, and pay your bills a bit more slowly without damaging relationships with your suppliers or incurring late fees. It's a balancing act.
Okay. And for businesses selling physical products, there's inventory again.
Yes, there's the average age of inventory, or days in inventory. This tells you the average number of days inventory sits on your shelf before it's sold.
Calculated how?
It's your average inventory value divided by your cost of goods sold for the period, multiplied by the number of days. It measures how liquid your inventory is, how quickly it turns into a sale.
And managing these three together, DSO, accounts payable, and inventory days, is key for cash flow.
That's what the folks at Forvis Mazars emphasize. Mastering that interplay is fundamental to keeping cash flowing smoothly.
Are there efficiency metrics related to people too, your team?
Oh, definitely. You can look at things like revenue per full-time employee, or if you're product-based, maybe gross profit per employee.
What do those tell you?
They give you a sense of labor productivity and efficiency. They can help you understand if you're staffed appropriately and help forecast future hiring needs as you grow.
It feels like with all these efficiency ratios, knowing if a number is good is really tricky.
It absolutely is. It's very industry dependent. A retailer will have vastly different inventory turnover than a software company, for example.
So the value isn't the number itself, but tracking your own trend and comparing it to industry benchmarks.
Exactly. As Berman and Knight suggest, track your trends, see if you're improving or declining, and try to find reliable industry data to see how you stack up. But remember, these numbers still rely on the data and sometimes the judgments made in your financial statements.
Okay, that's a great overview of profitability and efficiency. Let's shift to something that's often a huge expense, getting new customers. How do we measure the cost of that?
That brings us to customer acquisition cost, or CAC. Simply put, it's the total cost you incur to convince a potential customer to actually buy your product or service.
And it's more than just ad spend, right?
Oh yeah, much more. You need to include your marketing and sales expenses. That means salaries for those teams, commissions.
The software they use, like CRM or marketing automation tools.
Right. The cost of creating content and campaigns, the actual ad spend, travel expenses for salespeople, maybe even client gifts.
What about promotions? Like discounts for new customers or referral bonuses?
Those count too. Plus general advertising, event sponsorships, email marketing costs, and don't forget the cost of the team's time spent on these acquisition activities.
Even things like free installation or a free initial device, if that's part of getting the customer on board.
Potentially, yes. If it's a cost incurred specifically to acquire that customer and not billed separately, it can factor in. And even market research used to find those customers. It's comprehensive.
So how do you calculate a basic CAC?
The simple version is, take your total marketing and sales expenses over a specific period, say a month or a quarter, and divide that by the number of new customers you acquired in that same period.
Okay, so if I spend, say, $25,000 on all that stuff in June and got 25 new customers.
Then your CAC for June was $1,000 per customer.
$1,000, good or bad?
That's the million-dollar question. It depends entirely on how much value that customer brings back to your business over time. $1,000 CAC might be fantastic if the customer stays for years and spends tens of thousands. It might be disastrous if they buy once for $50 and never return.
Which leads us perfectly into the LTV.CAC ratio.
Exactly. This ratio connects the cost to the value. It compares the customer lifetime value, LTV, the total predicted revenue or profit from a customer over their entire relationship with you, to the customer acquisition cost.
And the calculation is just LTV divided by CAC.
Yep, LTV CAC. It's a super powerful metric.
Why is it considered so important?
Because it tells you about the fundamental sustainability and profitability of your business model. Are you spending money to acquire customers who will ultimately generate more value than they cost? It signals financial health, growth potential, operational efficiency.
And it's something investors look at very closely.
Absolutely. It shows if your customer acquisition engine is actually profitable in the long run.
Let's use that Clipfolio example. If CAC is $600 and the LTV is $2,400.
Then your LTV.CAC ratio is $2,400, $600, which equals 4 or 4.1.
Meaning for every $1 spent acquiring a customer, you expect to get $4 back over their lifetime.
Precisely.
Is there a target ratio people shoot for, like a rule of thumb?
The most commonly cited benchmark, especially in SaaS and subscription businesses, is 3.1, earning $3 back for every $1 spent.
What if it's lower, like 1.1 or 2.1?
That generally suggests you might be spending too much to get customers, or the customers you're getting aren't very valuable, or maybe they don't stick around long enough, your acquisition isn't really profitable.
And if it's really high, like 6.1 or 7.1, is that always good?
You'd think so, right? And it does show great efficiency. But it could mean you're underinvesting in growth. Maybe you could afford to spend more aggressively to acquire more customers, even if they only come in at a 3.1 or 4.1 ratio, and grow the whole business faster.
So there's a balance between maximizing the ratio and maximizing overall growth and profit.
Exactly. The ideal ratio really depends on your industry. E-commerce might aim lower due to thinner margins, your business model, and your current growth stage.
Okay, understanding CAC and LTV.CAC is one thing, but improving them, that's the real challenge. What can businesses actually do?
Lots of things, often working together. A really fundamental place to start, especially for boosting LTV, is just focus on customer experience and satisfaction.
Happy customers stay longer, spend more, tell their friends.
Precisely. That Bain & Company finding is powerful. A small 5% bump in retention can boost profits massively, like 25% to 95%. So really listen to feedback, share it internally, empower support teams, make customers feel valued.
What about getting more leads to actually convert into customers, improving that conversion rate?
Yeah, streamlining the sales process is key for lowering TAC. Make it easy for people to buy. Some sources suggest giving buyers more autonomy online. Don't be afraid to sell complex things digitally if that's what buyers want. Use the communication channels they prefer.
Like messaging apps instead of just email or phone.
Could be. Meet them where they are. Reducing friction in the buying journey directly impacts your conversion rate and thus your CAC.
And getting really specific about who you're targeting.
Crucial. Niching down and sharpening your message. Trying to be everything to everyone usually means you waste marketing spend attracting people who aren't a good fit, who won't stick around, giving you low LTV and high CAC. Define your ideal customer profile and speak directly to their needs.
What about the channels you use to reach them? Ads, content, social.
Finding the right mix is important. Owned media, like your blog or email list, builds value over time. Paid media, like ads, gets quick results, but you're always renting the audience. Earned media, like PR or viral sharing, can be huge, but it's less predictable. Optimizing your channel mix based on where your ideal customers are helps control CAC.
And testing. You mentioned testing.
Relentless testing, A/B testing, emails, ads, landing pages, offers, website copy. It's described as practically guaranteed to lower your CAC over time if you do it consistently and learn from the results. Test everything in your funnel.
Involving designers too, not just marketers.
Yes, design plays a huge role in conversion. Testing different layouts, visuals, button placements, it all matters.
What's the role of automation here? Marketing automation tools.
They can definitely help improve efficiency and potentially lower CAC if used wisely. But that Bill Gates quote is relevant. Automation applied to an efficient operation magnifies efficiency. Applied to an inefficient one, it magnifies inefficiency.
So get your processes working well first, then automate.
Pretty much. Don't buy a complex, expensive tool stack hoping it will magically fix broken processes. It usually won't.
You mentioned owned media. What about content marketing? Blogging, articles.
Hugely important for organic acquisition, which tends to have a lower CAC over the long term. Creating valuable, SEO-rich content, especially focusing on long-tail keywords, those specific phrases your ideal customers search for positions you as a resource.
Answering their questions, comparing solutions, addressing objections before they even ask.
Exactly. Become the go-to source of information in your niche. This attracts qualified leads over time, reducing reliance on paid ads.
And getting people talking, word of mouth.
The holy grail of low CAC. Encourage reviews, offer referral incentives, build a community, provide amazing service that people want to talk about. These customers often come in with higher trust and potentially higher LTV too.
Then there's just making the website and buying process smooth.
Absolutely. Optimizing your conversion engine. Fast loading pages, clear navigation, great mobile experience, compelling calls to action, easy checkout. Removing any friction that might cause someone to give up before buying. Every little improvement helps make your acquisition spend more effective.
And to directly boost LTV itself, beyond just keeping customers happy.
Think about enhancing the product or service value, new features, better performance. Develop smart upsell and cross-sell strategies, offer relevant add-ons or upgrades at the right time. And look at your pricing, maybe tiered subscriptions or bundles, encourage higher spending over time.
It really sounds like improving the LTV.CAC ratio involves working on many different parts of the business simultaneously.
It truly does. Marketing, sales, product support, they all play a role.
Okay, let's talk about business stages. Does a startup prioritize the same metrics as a big, established company?
The focus often shifts, yeah. Startups are usually laser focused on survival, proving their concept, and achieving rapid growth. Cash is king.
So things like burn rate are critical.
Absolutely critical. How fast are they spending the cash they have? That dictates their runway, when they need to raise more money, everything. Early customer metrics are also vital for them.
Like Net Promoter Score, NPS. How many users are actually using the product regularly? Retention rates.
Exactly. Activation rate, adoption rate, user retention. These show if they're achieving product market fit. Are people actually using it? Do they like it? Do they stick around? That's crucial validation early on.
What about their LTV.CAC ratio? Is the 3.1 benchmark relevant for a brand new startup?
They definitely track it, or should be. It might not hit 3.1 right away, and investors might understand that. But they need to show the potential that the unit economics make sense, that they can acquire customers somewhat efficiently, and that those customers will become valuable over time. It's about demonstrating a path to profitability.
Okay, so startups, burn rate, early user engagement, and showing potential on LTV.C. How does that compare to an established business?
Established businesses are often more focused on stability, optimizing what they already have, maximizing profitability, and achieving consistent performance.
So those core financial metrics we talked about earlier become more central.
Right. Profit margins, gross, operating net become key indicators of ongoing health. Efficiency ratios, inventory turnover, asset turnover, fine-tuning those cash flow cycle metrics like DSO and inventory days are crucial for optimizing operations and managing costs effectively.
And their LTV.C ratio expectations.
Generally higher. They should have a better handle on their acquisition channels and customer value, so they're expected to demonstrate a more mature balance between growth spending and profitability, often aiming for that 3.1 ratio or better.
But it's not like they completely ignore things like customer retention, right?
Oh, absolutely not. Many metrics are important for both. An established company still needs to keep customers happy, LTV, and acquire new ones efficiently. Tax. The emphasis just shifts based on their strategic goals and market position.
Okay, that clarifies the different perspectives. Now, with all these potential metrics, how often should you actually be looking at them? Is there a standard frequency?
It really varies. Some operational things, maybe daily sales or website visits, you might glance at daily or weekly.
But the bigger financial KPIs, profit margins, efficiency ratios.
Those usually come from your financial statement, so the rhythm often follows that. Reviewing them weekly or monthly helps you get familiar, spot trends early. If you're a private business, you could calculate margins weekly if your accounting is set up for it.
Public companies have the quarterly reporting cycle, so that forces a look.
Right. And if you have loans, your bank might require monthly financial reporting, which means you're looking at key metrics at least that often.
What about CAC?
That's when you ideally want a more continuous view on, maybe not daily calculation, but having a system or dashboard to monitor it regularly, not just once a quarter after the fact.
And marketing ROI.
Yeah.
You mentioned that means regular checks during a campaign.
Yeah, you don't want to wait until a 6-month campaign is over to find out it didn't work. As Investopedia points out, you need to calculate it periodically, maybe monthly, using sales growth attributed to the campaign versus what you might have expected organically. If the ROI isn't showing up after a reasonable time, you need to adjust or potentially cut your losses on that specific initiative.
So the general idea is regular, consistent monitoring based on the metrics' nature and your business needs.
Exactly. Choose the KPIs that matter most for your current goals, figure out the right frequency to track them, and then actually do it consistently to see how you're performing and where you need to focus your efforts.
It sounds incredibly valuable, but I can also see how business owners might struggle with this. What are some common roadblocks?
Well, a big one is just feeling overwhelmed. There are so many metrics you could track. Where do you even start?
Yeah, analysis paralysis.
Right. Another is simply lack of data. Maybe the systems aren't in place to easily capture the information needed, or having the data but not knowing how to interpret it. What does this number actually mean for my business?
Limited resources, time, or expertise to set up tracking and analysis.
That's a huge one, especially for smaller businesses. And finally, maybe the biggest hidden danger: inaccurate data. Garbage in, garbage out. If the numbers you're looking at are wrong, your decisions will be based on faulty information.
So, overwhelm, lack of data, difficulty interpreting, limited resources, and bad data. Quite a list.
It covers the main challenges. The solutions usually involve starting small full. Prioritize just a few key metrics tied to your most important goals right now. Get creative about finding or estimating data if perfect sources aren't available. Invest in learning basic analysis skills or get help. Use resources wisely, and put processes in place to ensure data accuracy from the start. Focus and data integrity are crucial.
Okay, so as we kind of bring this together, here's a thought to leave people with. We've talked about all these metrics: margins, turnover, CK, LTV, ROI, but it's worth remembering, as Karen Berman and Joe Knight emphasize, many of these numbers, even from formal financial statements, involve estimates and assumptions.
Right, accountants have to make judgment calls sometimes, and things like LTV or projected ROI are inherently based on forecasts about the future, which always have uncertainty. Even with fancy models or AI helping out, there's still a human judgment layer.
And building on that idea of judgment and perspective, what about transparency? Frederick Laloux talks about organizations where financial data is shared widely, with almost everyone. The idea is that if employees understand the numbers and see the business like the CEO does,
They might feel more ownership, make better decisions in their own roles, and overall productivity could increase. It's a fascinating concept.
So the provocative question for you, the listener, is, what could happen in your business if you decided to embrace a greater level of financial transparency? Could sharing more of these numbers internally unlock something unexpected?
Something definitely worth thinking about. What impact could that kind of openness have?
Absolutely. And if you found value here but haven't subscribed yet, why wait? Every subscriber fuels this channel to keep delivering the real game-changing content you need. Hit like, drop a comment, and subscribe. And on W, don't miss out on the next episode that could change everything for you.